Hey guys, welcome back to my channel. And I am going to go through a couple of different things. I'll start with top down, from big events to more specific stuff. So Fed is still likely going to cut the interest rate in September. They're probably going to go for about 25 to 50 basis points, which is about 0.25 or 0.5% interest rate cut. Now, what that probably means is gold and stocks are going to go up. Now, for a long time, they were trying to get inflation down to 2% ever since COVID because they printed tons of money, but that doesn't seem to be happening right now. So Jerome Powell, his Jackson Hole speech, basically said something like, yeah, we're probably going to be more flexible with how we measure interest rates, and we're probably going to just be more flexible instead of relying on that 2% inflationary growth every year. So that has pros and cons. What that means in terms of pros is that the economy will probably continue to keep running and people won't be as nervous that interest rates are going to stay high because it seems like it's likely they're going to lower interest rates. Now, if we do lower interest rates, but then the tariff inflation continues to linger, that's really bad because that's compounding problems. Tariff inflation plus lower interest rates means money is going to be flowing like crazy and inflation will go back up. So some people are hoping that tariff inflation is temporary, but I don't know. I think a lot of people say that prices are sticky, which means that when they go up, they tend to stay up. If you can charge $7 today instead of usually charging $5 for some object, like let's say a ball or a hamburger, then why wouldn't you just continue to ask people to pay you $7 even if the cost of the materials goes down? Because that's just more money you can pocket. So I think that prices will tend to be sticky, and I think that this can potentially mean the tariffs will become a big problem because they're going to keep jacking up the prices of stuff and then keep those prices high, just like during COVID when we saw people jacking up prices of lots of materials and lots of groceries, things like that. Now, talking about all this inflation and all of this costs, we've come to Congress. So Congress usually has to determine at the end of September whether or not to approve budgets for all these different kinds of things. And so one of the things that Polymarket is trying to figure out right now and bet on is, will the government have a funding lapse on October 1st? Now, basically, this means that the president fails to sign the bill by September 30th. So if Trump doesn't sign it, then that is considered a funding lapse. Now, on the other hand, there is a possibility that this is all just a big hullabaloo and there's nothing that's going to happen. The reason why I think this is an important thing to pay attention to is because if the government keeps shutting down, that's a huge problem for a lot of the operations that the government has, and also for things like jobs, because the government funds so many careers and so many people are employed by the government. So when we look at jobs now, we need to talk about two things. Number one is the JOLTS report. So the JOLTS report is basically job openings and labor turnover survey that they do in order to try and track how the economy is doing from the perspective of jobs. This is an interesting indicator right now because it seems like JOLTS is not good. So there are actually a couple of things that are all churning in the sky that seem like they're going to create this one big terrible storm. Number one, we've got these jobs reports which are coming in saying, oh, jobs are really hard to find. People are taking longer to find jobs. Then you have inflation from potentially lowered interest rates. Then you have inflation from the tariffs and the tariff impact. So all of this is to say, stagflation seems like a real possibility. And stagflation is the absolute worst that a government can have its citizens thrown into. So they need to do something to get us out of here. And if that means lowering interest rates to first stimulate the economy and potentially increase the number of jobs and stuff like that, I understand the rationale from that perspective. Now, when we actually talk about individual stocks, you might be confused because it seems like markets have been going up these past couple of weeks, but there are very specific stocks that are the forerunner winners. So it's mostly tech. And in tech specifically, Alphabet recently won a lawsuit and they don't have to sell Chrome. This is really big. And I think it's actually correct because Chrome for a long time competed against a lot of other browsers like Microsoft Edge, Firefox. I think there's one called Brave, DuckDuckGo, Safari. So there are a lot of competing browsers. So that's not, I think, where the monopoly lies. I think the monopoly is more about the search engine itself and things like that. But even that, you could argue that now that there's AI prompting and all of these different LLMs, people are starting to move away from search, and you can see that in their earnings, in their monthly active users and stuff like that. Google is losing some of their market share from search to LLMs and to chatbots and things like that because people are asking ChatGPT or some other chatbots these questions instead of Google. So let's keep an eye out on that, see what happens there. Another stock that's interesting was Klarna. So Klarna is buy now, pay later, and they basically have this way of financing things that makes it easier for people who don't have the money right now to afford stuff like an Apple iPhone or a sofa, a TV. Now, they are part of a lot of memes because a lot of times people use Klarna. They don't use Klarna, but I've seen people have the option to finance things like pizzas. I think Domino's pizzas could be financed. So you were joking about how dumb that sounds to finance a pizza because you can't pay for the whole thing. It feels rather dystopian. But then you see some other things like I think Wegovy. Yes, if we see here, there's Wegovy in the picture, so I'm guessing it's Wegovy. They have partnerships with these healthcare organizations or these groups that do certain kinds of pharmaceuticals and things like that, so that if you can't afford the full price up front, you pay it over a longer period of time. These kinds of financial schemes, so to speak, are a bit risky because you have to care a lot about who you're loaning money to. If you are loaning money to somebody who can't afford a full pizza, how likely are they to pay you back, even if you charge really high interest rates? Those high interest rates are likely not going to be able to compensate for the number of people who just take the money and run. And they're probably going to purchase really high ticket items, not things like a pizza, but things like phones, TVs, computers. So I'm a little bit skeptical about the long-term prospect of Klarna, but I could be convinced if somebody comes to me and says, hey, actually, you're missing out on this really big thing. Leave a comment if you think I'm missing something here, but I am a little skeptical about their customer base. If they make a lot of money from interest and from taking money directly out of people's paychecks and also taking the interest out of their paychecks too, maybe I could see a case for them because then they don't have to keep begging or chasing people for money. They directly take that money out of a checking account. So we'll keep an eye out on their IPO and see what happens. Now, let's see. I think we've covered the Fed, Congress, and the jobs reports. But I didn't talk about the upcoming jobs report. So there's one coming out on Friday, 5:30 a.m. Pacific time, that is going to give us more information about unemployment rates and how things are going in the economy at large. This is probably going to be extremely impactful to the stock market, to the economy, and to federal policy. Because if we see a really high unemployment rate, that's going to give more justification for rate cuts, more justification for bigger rate cuts, and potentially I don't know this for a fact, but maybe Trump looks at how things are, how the economy is doing, how people are feeling, and think, oh, maybe I should try to dial back on the tariffs and stuff like that. So all of this remains to be seen. It's all speculative right now, so there's not much to go on, but it's all stuff that I think is important to keep track of. There is a bit of a semiconductor slowdown, so it seemed. AI seems to be taking a bit of a breather right now, but I think in general, we're probably going to start moving towards AI-focused group of companies that are going to be the front runners. The way I like to think about this bubble is that there are always going to be some that do very wildly successful, and the rest are all mostly going to pewter out to different degrees or settle into some so-so level of performance. And the way I see it is, think about during the dot-com boom and then bust in the early 2000s. What you saw then was a whole bunch of crap companies that had no product, no discernible strategy or anything like that, who just, oh, we made a website. Oh, wow, our valuation just doubled. There wasn't a lot of thought put into those things. I'd like to think that investors have actually become more knowledgeable and more thoughtful about the valuations of these different stocks. If you look at the stock market today, I do think that it prices in how much people are spending on this. And I think people just believe that it's an economies of scale sort of thing. So you have to spend a lot of money on semiconductors, on energy, all that stuff in order to get really big returns. And I genuinely believe that for a very select few companies, that can be massively profitable. So that might be NVIDIA, who makes the semiconductors. That might be Southern Co., who helps to supply the energy to the data centers, or one of those data center companies. It could be the data brokers that you have to get data from in order to generate your large language models. It could be the large language model companies themselves. But I think the large language models and the makers of the large language models like OpenAI, Facebook Research Labs, they get or Google, they get so much attention. And meanwhile, people weren't really paying attention to the semiconductors for a while when ChatGPT first came out. So similarly, I don't think people are paying attention a lot to the energy costs that these things are going to require. And we might start to see the actual investments going into energy in the next year or two. But at least for now, I would say utilities are a great bet, not just because they are the foundation for AI, but even if you don't believe the AI hype, even if you think that it's going to pewter out and everyone's going to cut off spending tomorrow, it's actually historically a safe bet in recessions because people still have to pay for electricity. They still have to pay for heating. So utilities tend to be a great baseline. I'm personally very bullish on utilities. I don't have any investments in utilities right now, but I think I'm probably going to start trying to look deeper into those and maybe make plays there. All right, I've been talking enough, and I hope that you got something useful out of this. I'll catch you in the next video, and I hope you like and subscribe. Thanks.